First of all, there was a landmark deal on tax. Does that actually change the way that countries will operate amongst each other and companies really taxed, or are there going to be processes that make it much more difficult than it looks on paper?
Well, your correspondent was right that there's quite a bit of work to be done since after this agreement, because the G7 is, seven, and there are plenty of other countries out there. Now, you may assume that with some of the biggest other countries, they've probably done some pre-cooking of this. But it will be hard to get it through both in Europe and more broadly, because there are some countries, Ireland being one, which have made considerable play of their low tax environment. And that's going to be a bigger change for them than it is for the UK. So there is quite a lot of work to be done. But it is significant that the US have been prepared to do this deal or to announce this deal, because in the past they've not been prepared really to exert themselves on international tax questions. So that's the biggest, most significant change, I think.
When you look at inflation, I don't know how much we should worry about inflation now. And it goes to the big debate, Sir Howard, of the people like Janet Yellen that say, look, this is transitory because of the pandemic. And then the critics that I guess worry that because of this infrastructure plan and this huge spending from the US and elsewhere, we're going to have fast rising inflation that's here to stay.
Yeah, I think the US are being a bit confusing here. And I think it would be good if we heard one message from the US, because on the one hand, you've got Janet Yellen actually saying, well, maybe a rise in interest rates would be a good thing. And as a banker, I could hardly disagree with that. That would actually be quite positive from a bank's point of view. On the other hand, you've got the Fed saying, well, we are going in future to adopt an average inflation approach, whereby if there is an undershoot of our 2% inflation target for a period, then we will compensate for that by allowing inflation to be above the target for a period. The difficulty is that they haven't said when the period starts. How far back do you go in looking at what past inflation has been? But in fact, if you think that through, it's not the same as what Janet Yellen is saying, because what the Fed is saying is we may not raise rates and allow inflation to be higher than the target for a period, whereas she's saying, well, higher rates might be a good thing. So I do think this is a bit confusing for the market at the moment, and it would be quite good if we had one consistent message from the US.
But Sir Howard, is it maybe then a message from Secretary Yellen in saying actually, the Biden administration will stick to the $4 trillion spending plan no matter what happens?
Well, the trouble is it's slightly back to front, because it's normally the Fed who talk about interest rates and the Treasury who talk about spending. And now you've got the Treasury giving an interest rate forecast, which, as you know, Francine, in Europe and in the UK would absolutely not be done. I mean, there'd be huge alarm if Rishi Sunak started talking about interest rate policy. Or indeed, Macron started talking about interest rate policy, because those are central bank things. So there's a confusion about who's saying what and why, and I find that rather difficult.
Sir Howard, how do you see the recovery taking shape? Is it going to be a stronger recovery than we thought, or are we getting ahead of ourselves and crying victory?
I am quite bullish at the moment from what we are seeing at the bank and from what the Bank of England are saying. I think that we can expect that quite a lot of the spending that was foregone last year will now come through quite quickly. Now, it'll be largely consumer spending, but the Bank of England estimate that people have saved about 10% of their total annual expenditure. And if they only spend half of that in the next 6 to 9 months, that's a big boost to consumer spending. So in the short run, I am quite optimistic about the bounce back. And you can see indications of that in the housing market. You can see it in the labour market with vacancies rising. The bigger question is where we settle after that. Because what we found in the last global financial crisis was that we did have a bounce back, but then we settled back to a trend growth rate which was lower than the one we went into the crisis with. So the bigger question, I think, is will we come out of this and start to grow more rapidly on a consistent basis after this immediate bounce back? And the trouble there is that we haven't seen investment rise yet, because that's been the key failing, I think, particularly in the UK, but elsewhere as well, that investment has been relatively weak. And unless investment picks up, it's hard to see why we would end up with a sustainable growth rate that's higher than we went in. So I'm, optimistic in the short run and a bit cautious in the medium term.
And so why do you think that investment hasn't picked up, Sir Howard? Is it, chief executives being especially cautious because of variants and I guess the uncertainty of further lockdowns, or is it something deeper?
I think it's something deeper, because it is something that's been persisting now for quite some time. The UK has had a lower investment rate than any other G7 country for a decade. So it's not just a COVID point, nor is it just a Brexit point. I mean, some people have said, well, it's post-Brexit investment has been weaker, but it seems to date back further than that. It just seems that somehow the domestic companies in particular, because inward investment's been relatively strong, are not disposed to invest. They're not confident about the profile of demand in the future. And that's the problem that we face in the UK, and so far we haven't cracked that.
When you look at the relationship between the government and the banks, how's it going? It seems that, very different to '08, the bankers are now seen as part of the solution to the recovery.
Yes, the government has said that, which is nice. And so, I think there is a collaborative relationship at the moment, and there aren't really any main huge issues. I mean, the government are consulting on the bank tax surcharge, and you won't be surprised to know that I think that should be reduced. But the fact that they're consulting on it is positive in itself. There aren't really any huge issues with the Bank of England on regulation at this point. The bank have changed their view on dividends, so we're allowed to pay dividends again. So whereas 12 months ago, I think I'd have listed a litany of issues where we were somewhat not at one exactly with the government and the bank, that's not really the case. The big issue now, of course, is financing the recovery. I don't think there's a big issue on the personal side, because as we've just been saying, individuals have saved a lot of money, so they've got money to spend. On the corporate side, we're ready to lend. The issue, again, as I've been explaining, is whether there'll be enough investment demand. So I think that's the big question. How can we get investment demand moving?
Sir Howard, what exactly is the main message from NatWest to the government? So I know there's a number of questions from the Chancellor, including, fintech, green finance. What do you want to make sure that authorities listen to?
Well, I think that our position is probably be the same as many other businesses, which is that we think that an environment of some predictability is important, and therefore that people should have a clear view of a kind of roadmap to reopening, and recognizing that things can change, what would need to change in order for that roadmap to be amended. I think that kind of certainty, not absolute guaranteed certainty that things will open at a particular time, because we understand that's unrealistic, but an understanding of what the factors are and what makes the decisions about whether things get opened or not. And as you've heard, the travel industry is not happy that those decisions have been particularly transparent in the past. So some certainty is required. I think also from a finance side, we would like to see the signs that the government has a plan to deal with its excess debt over a period, not in the short term. I don't think that's appropriate now. But how will taxes be adjusted in the future? And just corporation tax doesn't seem to me to be a likely solution for the long run. So the government's going to have to find some way of replacing fuel duty, which is clearly declining, and some way of balancing the books. So some certainty there as well is helpful. But I don't think this is a moment at which the government and the banks are at loggerheads on any big issues. This is a free and open discussion about just how best to finance the recovery that we all want to see.
And so, Howard, when you look at actually the, Brexit and London, how can London remain competitive?
Well, yes. I mean, my view is that London still has a very important role to play in financing Europe, but largely as its offshore centre now, rather than a purely onshore centre in Europe, which is what we've been for the last 20 years or so. Now, the individual industries, sectors of finance will have particular shopping lists. The insurance industry, for example, would like to see some reforms to Solvency II. The banking sector is not demanding a lot because, of course, much banking regulation is in fact global, not European. The main rules on bank capital, which are the most important thing for banks, emerged from the Basel Committee. The European Union is represented there, but so are we, so we always have been. So I don't think that it's an issue there where you say we leave Europe and therefore we change our bank capital regime, because our bank capital regime is a global regime. So I think it's more in the areas of the stock market. There have been some proposals for making listings easier in insurance, for Solvency II, where it is possible to consider some changes in the UK which are different from the ones we have in Europe. But on bank capital, which is the most important thing for banks, it's global. So there's no point in trying to pretend that you can gain some advantage in Europe by changing it.
Wonderful. Thank you so much for all of your insight. Sir Howard Davies there, NatWest Group Chairman.